Hello students, today we are going to learn few topics in catering management, which includes accounting ratios, importance, its significance and limitations, and types of ratios. Coming to the objectives, it is to define and explain the term accounting ratios, to learn advantages and limitations of using accounting or financial ratios, to know how financial ratios are classified. A financial ratio or accounting ratio is a relative magnitude of two selected numerical values taken from an enterprise financial statements. Often used in accounting, there are many standard ratios used to try to evaluate the overall financial condition of a corporation or other organization. Financial ratios may be used by managers within a firm, by current and potential shareholders or owners of a firm, and by a firm's creditors. Financial analysts use financial ratios to compare the strengths and weaknesses in various companies. The point to be noted is that a ratio reflecting a quantitative relationship helps to form a qualitative judgment. A comparative study of the relationships between various items of financial statements reveal the profitability, liquidity, solvency as well as the overall position of the concern. As ratios are simple to calculate and easy to understand, there is tendency to employ them profusely. The absolute accounting figures reported in these financial statements do not provide a meaningful understanding of the performance and financial position of the concern. An accounting figure conveys meaning when it's related to some other relevant information. Ratios are useful indication of the progress, position and prospects of a business unit in which the many parties are interested in different ways. Accounting ratios, also called as financial ratios, are used in analyzing financial statements. A ratio shows the relationship between two amounts. However, a ratio by itself may have no meaning until it is compared to ratios from previous years, also called as time series analysis, or ratios of other firms in the same industry, called as cross-sectional analysis. Financial statements aim at providing financial information about a business enterprise to meet the information needs of the decision makers. Financial statements prepared by a business enterprise in the corporate sector are published and are available to the decision makers. These statements provide financial data which require analysis, comparison and interpretation for taking decision by the external as well as internal users of accounting information. Now, this act is termed as financial statement analysis. It is regarded as an integral and important part of accounting. This information covers the technique of accounting ratios for analyzing the information contained in financial statements, for assessing the solvency, efficiency and profitability of the enterprises. Now, what is an accounting ratio? Accounting ratios are an important tool of financial statements analysis. A ratio is a mathematical number calculated as a reference to relationship of two or more numbers and can be expressed as a fraction, proportion, percentage and a number of times. When the number is calculated by referring to two accounting numbers derived from the financial statements, it is termed as accounting ratio. It needs to be observed that accounting ratios exhibit relationship, if any, between accounting numbers extracted from financial statements. Ratios are essentially derived numbers and their efficacy depends a great deal upon the basic numbers from which they are calculated. Hence, if the financial statements contain some errors, the derived numbers in terms of ratio analysis would also present erroneous scenario. Further, a ratio must be calculated using numbers which are meaningfully correlated. A ratio calculated by using two unrelated numbers would hardly serve any purpose. Coming to objectives of the ratio analysis, it is indispensable part of interpretation of results revealed by the financial statements. It provides users with crucial financial information and points out the areas which require investigation. Ratio analysis is a technique which involves regrouping of data by application of arithmetical relationships, though its interpretation is a complex matter. It requires a fine understanding of the way and the rules used for preparing financial statements. Once done effectively, it provides a lot of information which helps the analyst. That is, to know the areas of the business which needs more attention, to know about the potential areas which can be improved with the effort in the desired direction, to provide a deeper analysis of the profitability, liquidity, solvency and efficiency levels in the business, to provide information for making cross-sectional analysis by comparing the performance with the best industry standards, and to provide information derived from financial statements useful for making projections and estimates for the future. Now, what is an accounting ratio? It is a fraction whose numerator is the antecedent and denominator the consequent. It is simply an expression of one number in terms of another. It may also be defined as the relationship or proportion that one amount bears to another, the first number being the numerator and the later the denominator. Pure ratio, example, a ratio between debt and the equity, say 1:1. Ratio which refers to ratios ascertained with reference to time period, example, working capital turnover ratio 3 times a year. Percentage, example, net profit of 20% on sales. Coming to the importance of ratio analysis and scrutiny of the past result. It helps to analyze the probable causal relationship among different items after analyzing and scrutinizing the past result. Preparation of budgets. The ratio that are derived after analyzing and scrutinizing the past result helps the management to prepare the budgets and estimates, to formulate policy and to prepare the future plan of action, and thus helps as a guide to harmonize among different items for preparing budgets. It also helps to take time dimension into account by trend analysis, namely whether the firm is improving or deteriorating over a number of years that can easily be studied by the trend analysis. So, comparison can be made without difficulty by the analyst and to see whether the said ratio is high or low in comparison with the standard or normal ratio. It also throws light on the degree of efficiency of management and utilization of assets, and that is why it is called surveyor of efficiency. It also helps to make an inter-firm comparison either between the different departments of a firm or between two firms employed in the identical types of business, or between the same firm on two different dates. Thus, the comparative analysis can be made possible between the industry average ratio and the ratio of each business unit. Short-term liquidity position, namely whether the firm is able to maintain its short-term maturing obligations or not, that can easily be known by applying liquidity ratios. At the same time, long-term solvency position can also be measured by application of leverage or profitability ratios. Thus, the ratio is an invaluable aid to the users of financial statements. With the help of ratio analysis, meaningful information can be communicated to the users of accounting information, and as a result, the analyst can draw the right decisions. Formulating the government policies. Since ratios are the tools to measure industrial efficiency and performance, the governments take various financial policies on the basis of the results of various related ratio analysis. Measuring the corporate sickness. Undoubtedly, ratio analysis helps us to measure the corporate sickness well in advance so that the management, shareholders, and other interested parties may take proper steps to avoid such a situation. Testing the long-term solvency position. This long-term solvency position can be tested with the help of ratio analysis. For example, debt equity ratio, capital gearing ratio. So these ratios help the analyst to assess the long-term debt paying capacity of the firm. Prospective investors, long-term creditors are interested to measure the long-term solvency position before taking investment decisions. Superiority of ratios over absolute figures. It is a well-known fact that one cannot arrive at a definitive conclusion about the financial health of an enterprise simply by studying and scanning the absolute figures contained in the conventional form of financial statements, namely revenue statement and the balance sheet. So the same is possible only when the absolute figures are analyzed further in terms of ratios that one can assess properly. So that is why ratio analysis has taken an important role in the field of managerial accounting. So coming to the advantages of ratio analysis, the ratio analysis, if properly done, improves the user's understanding of the efficiency with which the business is being conducted. The numerical relationships throw light on many latent aspects of the business. If properly analyzed, the ratios make us understand various problems as well as the bright spots of the business. The knowledge of problem areas help management takes care of them in the future. There are many advantages derived from ratio analysis. These are summarized as follows. Firstly, it helps to understand efficacy of decisions. Second is to simplify complex figures and establish relationships. Ratios help in simplifying the complex accounting figures and bring out their relationships. They help summarize the financial information effectively and assess the managerial efficiency, firm creditworthiness, earning capacity. Next is it is also helpful in comparative analysis. The ratios are not being calculated for 1 year only. When many year figures are kept side by side, they help a great deal in exploring the trends visible in the business. The knowledge of trend helps in making projections about the business, which is a very useful feature. Identification of problem areas. It also helps in identifying the problem areas as well as the bright areas of the business. Problem areas would need more attention and bright areas will need polishing to have still better results. Ratios also help a great deal in explaining the changes occurring in the business. The information of change helps the management a great deal in understanding the current threats and opportunities and allows business to do its own SWOT, that is, strength, weakness, opportunity, threat analysis. Ratios help comparisons with certain benchmarks to assess as to whether firm's performance is better or otherwise. For this purpose, the profitability, liquidity, solvency of a business may be compared over a number of accounting periods with itself, that is, intra-firm comparison or time series analysis, or with other business enterprises, that is, inter-firm comparison or cross-sectional analysis, or with the standards set for that firm or industry, that is, comparison with standard or industry expectations. Coming to the limitations of ratio analysis, since the ratios are derived from the financial statements, any weakness in the original financial statements will also creep in the derived analysis in the form of ratio analysis. Thus, the limitations of financial statements also form the limitations of ratio analysis. Hence, to interpret the ratios, the user should be aware of the rules followed in the preparation of financial statements and also their nature and limitations. So, the limitations of ratio analysis, which arise primarily from the nature of financial statements, are: one is, the accounting data gives an unwarranted impression of precision and finality. In fact, accounting data reflect a combination of recorded facts, accounting conventions, and personal judgments which affect them materially. For example, a profit of a business is not a precise and final figure. It is merely an opinion of the accountant based on application of accounting policies. The soundness of judgment necessarily depends on the competence and integrity of those who make them and on their adherence to generally accepted accounting principles and conventions. The financial accounting is based on stable money measurement principle. It implicitly assumes that price level changes are either non-existent or minimal. But the truth is otherwise. We are normally living in inflationary economies where the power of money declines constantly. A change in the price level makes analysis of financial statement of different accounting years meaningless because accounting records ignore changes in the value of the money. Accounting provides information about quantitative aspects of the business. Hence, the ratios also reflect only the monetary aspects, ignoring completely the non-monetary or qualitative factors. There are differing accounting policies for valuation of inventory, calculation of depreciation, treatment of intangibles assets, definition of certain financial variables, available for various aspects of business transactions. Now, these variations leave a big question mark on the cross-sectional analysis. Forecasting of future trends based only on historical analysis is not feasible. Proper forecasting requires consideration of non-financial factors as well. So the various limitations are means and not the end. Ratios are only the means to an end rather than the end by itself. Their role is essentially indicative and of whistleblowing and not providing a solution to the problem. There is a lack of standardized definitions of various concepts used in ratio analysis. There is no universal yardstick which specifies the level of ideal ratios. There is no standard list of the levels universally acceptable, and in India, the industry averages are also not available. A ratio calculated for unrelated figures would essentially be a meaningless exercise. Hence, ratios should be used with due consciousness of their limitations while evaluating the performance of an organization and planning the future strategies for its improvement. Coming to the classification of accounting ratios, ratios may be classified in a number of ways to suit any particular purpose. First is the classification of ratios, traditional classification or statement ratios, then profit and loss account ratios, revenue or income statement ratios, balance ratios or position statement ratios, composite or mixed ratios or interstatement ratios. Classification according to the tests: profitability ratios, liquidity ratios, activity ratios, leverage ratios or long-term solvency ratios. Now, according to the importance, ratios are classified as primary ratios and secondary ratios. So, there are two ways of classifying the ratios. One is the traditional classification and next is the functional classification. The traditional classification has been on the basis of financial statements to which the determinants of ratios belong. On the basis, the ratios are classified as the statement of profit and loss ratios. A ratio of two variables from the statement of profit and loss is known as statement of profit and loss ratio. Balance sheet ratios. In case both variables are from the balance sheet, it is classified as balance sheet ratios. Composite ratios. If the ratio is computed with one variable from the statement of profit and loss and other variable from the balance sheet, it is called composite ratio. The alternative classification based on the purpose for which a ratio is computed is the most commonly used classification, which is as follows. Firstly, the liquidity ratios. To meet its commitments, business needs liquid funds. So, the ability of the business to pay the amount due to stockholders as and when it is due is known as liquidity, and the ratio calculated to measure it is known as liquidity ratios. They are essentially short term in nature. Three liquidity ratios are: current ratio is one of the most commonly used ratio. Quick ratio is equals to quick assets by the current liabilities, where quick assets equals cash plus the short term securities plus the accounts receivable. The net working capital ratio equals the current assets minus the current liabilities by the total assets. Solvency ratios. Solvency of business is determined by its ability to meet its contractual obligations towards stakeholders, particularly towards external stockholders, and the ratio calculated to measure solvency position are known as solvency ratios. These are essentially long term in nature. Next is the activity ratios or turnover ratios. This refers to the ratios that are calculated for measuring the efficiency of operations of business based on effective utilization of resources. These are known as efficiency ratios. Activity analysis ratios show how efficient the organization has been in using its assets to generate the sales and includes inventory turnover ratio, which equals to cost of goods sold by the average inventories. Accounts receivable turnover ratio equals the sales by the average accounts receivable. Assets turnover ratio equals sales by the average total assets. Then coming to profitable ratios, it refers to the analysis of profits in relation to revenue from operations or funds employed in the business, and the ratios calculated to meet this objective are known as profitability ratios. Profitability ratios show an organization's returns on investment. Next is the capital structure ratios show how an organization has financed the purchase of assets, which includes debt to equity ratio, which equals total liabilities by the total stockholders' equity. Interest coverage ratio, which equals income before income taxes and interest expense. Debt to asset ratio, which equals total liabilities by the total assets. Next is the market value ratios, which shows the value created for shareholders, which includes price earnings, that is the price per share of common stock by the earnings per share. Then dividend yield, which equals the per share dividend by the per share price. Dividend payout ratio, which equals the common stock cash dividends by the net income. Market to book ratio equals the common share market value by the common share book value. Thank you.